One key aspect which we touched here was credit rating report. Credit rating report is an important aspect because it gives us an outsider's perspective as well. So we as an investor, we analyze companies from equity investment perspective. So there is somebody else who has analyzed the company from a debt lending perspective, and as regulatory agencies have mandated that credit rating reports should be made available for companies which have taken debt or have taken debt from either banks or from markets. So the information which is given to credit rating agencies by the companies is almost at par with the information which is given to banks. And banks, because they become lenders, and lenders have got superior claim than equity shareholders. Equity shareholders have got the last claim. If anything is left after selling the company, then equity shareholders come. Lenders come above it, and because their claim is superior, they get access to information which is normally not available with the equity shareholders. And because credit rating agencies, they are treated at par in terms of access to information with banks, so credit rating agencies also get information, access to information which is usually not available to equity shareholders. So and based on that information, credit rating analysts, credit rating agencies, they make their opinion, and then they prepare the report. In the report, there are two sections. One section is their opinion about how safe it is to lend to a company, and this opinion they formulated and presented in the terms of a scale. We will see what that scale is. So there are two aspects to it. One is the opinion, and the second is data or information backing that opinion. So if they are saying it is very safe to lend to a company, then they will, in short, they will describe why it is safe. It is the largest company, has got very large cash flow, very low debt, etc., etc. So that information is the second part which we are interested in, because many times in that information descriptive part, we may get glimpses of information which otherwise is not disclosed to equity shareholders, and which might be very critical for decision making. Just like if there is a company which has got, say, which makes 80% of the sales to a single supplier. If that supplier goes bankrupt, then there is very high probability that the company will take multiple years to reach to a previously achieved sales level, because it will have to find new customers for 80% of the production capacity. But company, because of their wish to contain this information or not expose their weaknesses to markets and competitors, might not disclose it. But in credit rating report, you might find one line citing that most of the sales are to one customer, or customer concentration risk, etc. So that one line, which otherwise is not available in the public domain, not disclosed by the company, we might get to know about this information from the credit rating report. Or there are cases where companies might not disclose production capacity. What is the total production capacity, or what is the capacity utilization levels? This information is disclosed to credit rating agencies, and they might put this information in the credit rating report. Other critical information pieces, like a company which is under stress and wants to sell assets to get some money to reduce its debt. So if the company enters into a sale purchase agreement or sale agreement of related to its asset with a third party buyer, now the company might disclose that the sale agreement has been signed and it will receive XYZ amount of money, let's say 1,000 crore, and out of the debt which has on its books say 2,000 crore, this 1,000 crore would be utilized to pay that debt, and then the debt would reduce by half, and our financial situation will improve. So it's a very good news. So everybody should be happy about it. But there might be some glitches or some conditions in that agreement. Suppose it is a land which is being sold, and land might have encroachment into certain section by somebody, or the land which is currently forest land, and say, or it has got some reservation from regulatory authority that it cannot be utilized commercially. So the buyer might say, I'll out of 1000 crore, I'll give you 500 crore now and balance 500 crore I'll give you once you get these approvals or you clear out that encroached portion of land, etc. So it might be contingent upon the seller meeting certain milestones. And a person would get to know of these things only when the sale agreement is made available to us. Such agreements are not made available to equity shareholders, but these agreements are made available to credit rating agencies. So a credit rating agency, when they will update their view or put up an updated report, then they might say that the out of 1000 crore, 500 crore would be received upfront and balance 500 crore would be subject to a company achieving certain milestones, etc. So we would be able to get that information, or we would be able to sense that everything is not as clean as it is being projected. So those one lines of cautioning which we might be able to get from the credit rating agency, this information we might not get from anywhere else. So it becomes critical for us to read credit rating report for all the companies which we are appraising. Now we will see one sample report of Vinci Organs which you have downloaded. Yes, please. Okay. So this is one question. There was another question from there. Yeah. Yeah, please. Yes. Yeah, this is a common question. I'll answer this question as well. So this is, yes, please. Okay. Yes. Yes. Yes, sir. I'll answer this. Let me address, because these are common questions which will get answered in the discussion. You keep a note of it. If any of this doesn't get answered, then you ask me that question. Yes, what was your question? What aspects? Many times companies, they disclose it in their presentations, but many times they do not. So now let us see the one sample credit rating report which we had downloaded for Vinci Organics. So this report is 5 pages, but if you see 1, 2 and this 2.5, it is a 2.5 page report. After that it is about care ratings, certain other annexures, contact details, etc. So all the information related to company which the agency is disclosing is this summary rationale is within these two pages, which will take around 10 to 15 minutes to read. So like I told, there are two sections. One is opinion, another is information backing that opinion. So opinion, when credit rating agencies, they disclose or they give the opinion about the safety of the money being lent to the company, they give it in the form of a number over a spectrum, a character. It starts with, there are two types of rating, long-term ratings and short-term ratings. Long-term rating is where money is given for more than 12 months duration. Short-term rating is where money is given for less than 12 month duration, or even if the facility the facility is or the loan is renewable. Renewable in the sense, after every 12 months the lender takes a call whether to renew the facility for next 1 year or not. It means within 12 months the lender can take a decision to stop the facility. So all those are short term. Long term is where loan is given for more than 1 year duration. So for both these aspects, long term as well as short term, there are different connotations. It starts with AAA, then AA, then single A, then triple B, then double B, then single B, then C, and then D. And for short term, it is A1, A2, A3, A4, and D. So this is the spectrum where AAA means there is very highest safety. It means you give money to a company which is rated 111, there is very low probability that you will not get it back. In all probability you will get it back. And on D means highest risk. It is already not repaying money to people from where it has taken debt. Similarly here A1 is the highest one, and D that the company is already in default. So these are 7-8 characters, and they further granularize this spectrum by adding 3 suffixes, say plus, neutral and minus, Similarly, plus, neutral and minus. Similarly here. So adding these suffixes doesn't change the interpretation. It's only that the bracket is further subdivided into three aspects. Like AAA is safer than AA. Within AA plus is safer than AA neutral. AA neutral is safer than AA minus, and AA minus is safer than A plus. This is the opinion which is being given. On the short term size, again there are plus, neutral and minus. So instead of these 4, there would be 12 sub brackets. While interpretation remains the same, the higher you go, the safer it is in terms of the opinion of the credit rating agency that it is safer to give money to this company. This is the opinion. Now let's come to the information which is there. So like in case of Vinti Organics, here says that its short-term bank ratings is A1+. A1+, here you would see is the highest possible short-term credit rating. And then in the long-term credit rating, you will see it is saying that it is AA-. AA- is somewhere over here. So it is in the entire spectrum, it is fairly on the higher side, quite safe as per their opinion. And credit ratings also give you the rating action. Which is the rating action? It means how the rating has changed from the previous year's rating. Credit rating reports need to be revised, and minimum revision frequency, or say minimum every year the opinion would be revised. Now it depends upon the higher is the risk, it means the lower is the credit rating, or the higher is the loan amount, the frequency might change. So if a company has taken 1,000 crore worth of loan, and if the company is AAA rated, so it might be that once a year review is okay. But if the 1,000 crore worth of loan is given to a company which is BB rated, risk is higher, so the credit rating agency might review it every 6 months or might review it every 3 months. So this is the basis based on riskiness, whether the loan amount is higher or the risk in the credit rating is higher, the frequency changes. So, and credit rating reports, they tell you how the rating has changed over previous years. Now they also add an annexure like this, where there is rating history. So, pardon? That is another outlook, what they believe. So we will come to that also. So rating history of last 3 years. In last 3 years, you see in 2014-15 the rating was A. 15-16 rating got upgraded to A+, and then in 16-17 it got upgraded to AA-. So this trend shows that over last 3 years, in the terms of expectations of the assessment of credit rating agency, the safety or the strength of the company has improved. So what we believe is, like somebody said, how much weightage do we give? There is something, like I said, there is opinion about the safety of the company, and then there is information. This opinion section we ignore altogether, because it's our money which we are investing, so it should be my role to judge and not rely upon what somebody else telling me that it is the safest possible instrument, you please close your eyes and invest. No. That decision, how safe or how fundamentally sound the company is, that decision has to be taken by me. So this aspect, the top half, we totally ignore. And then we come to the section which is critical aspect, because of which I am spending those last 15-20 minutes here, is this, where the information is there. Like I said, many times critical information is reported within these 1 or 2 pages of crux of the entire company's business. So here it says, it usually includes 3 things. What are the strengths, what are the weaknesses, and what are the parameters which someone should monitor going ahead. Like here it will say the reaffirmation of the rating continues to derive strength from its healthy financial risk profile, healthy profitability, favorable capital structure, comfortable debt to equity. All this we have already taken care of by putting those parameters in screener, that it is more than 15% sales, less than 0.01 debt to equity. So we are rest assured that all these parameters would be met. Now comes the critical things. Derive strength from long track record, extensive experience of promoters, its dominant position globally in its key products like IBB and ATBS. Dominant position globally. This one statement tells you that on the level of world market, it is a key player in its key segments. This and also presence of long-term supply contracts with reputed client base. So at least its demand is protected because it has got long-term contracts with its reputed client base. So even though in this summary we might not find the name of the clients, many a times credit rating agencies do tell the name of clients also. When we will scroll below, we will find that the name of clients are here. So they are, however, constrained by, what are the constraints? Modest size of corporation. It's a moderate 600-700 crore net worth company. Product concentration risk. So these two key products, IBB and ATBS, they constitute the primarily about 70-75% of the sales amount. Then volatility in the prices of the crude based raw material. So this is another input, that its raw material costs are linked to crude oil prices. Foreign exchange fluctuations, primarily an export driven company, and significant planned capital expenditure towards the launch of the new project. So it is launching new products and large capex is being planned. So this also tells us that going ahead the company is going to consume a lot of cash, and if we are able to get the amount of that cash which it would require, we can fairly make an assessment that going ahead whether it would be able to generate that cash from its own resources or it will have to raise debt or go for equity dilution, etc. But to make that opinion, we should at least know that the company is doing capex. And in this report, within first two paragraphs, we have got a lot of it's a capsulated information. Now going forward, ability to scale up operation, healthy profitability margins, product diversification, favorable capital structure together with successful implementation of capex are the key rating sensitivities. So depending upon how the rating agency expects that things would pan out in future, it gives a outlook also. Outlook might be that if the rating agency believes that going ahead the things are going to improve in the terms of opinion of the credit rating agency, it might give a positive outlook. If they believe that it's expected to remain same, they may give it stable outlook, and if they believe that going ahead things are expected to deteriorate, they might give it negative outlook. But that again is their opinion, and we ignore opinion. We only seek this report as an information source and treat it just like that. Consume this information to make your own opinion. Now you see here, long-term track, whatever is being discussed in these three paragraphs is detailed a bit here. Long track record, growth in revenue, finance, favorable capital structure, global leadership. It even tells you that for IBB, the market position is that about 65% is of market share of the global market. And for ATBS, it is the only Indian manufacturer and largest producer of ATBS. Then long-term relationship with clients, here are the name of the clients: BASF, Mitsubishi, Hubei, Dow Chemicals, Nalco Company, etc. These names are otherwise not available in the annual report. These names are otherwise not available in the company's website, etc. So credit rating reports many times tell you the information which is otherwise not available. So if let us suppose there are 100 investors analyzing a company and 5 of them read credit rating report, you automatically differentiate yourself from other 95% of the investors. Weaknesses. In weaknesses it says product concentration, exposure to raw material volatility. Here there is important point in this paragraph. It says crude derivatives like toluene, etc. are the key raw material. As crude prices change, the pricing of these raw materials change. The company is able to pass on the increased cost of raw material to its customer with a time lag of 3 months. In case of ATBS, and for 1 month for all products including IBB. This one line is very essential for us to assess the strength in the business of the company. What I believe is that if a company has the ability of passing on increase in cost to its customers, it must be doing something really good for the customer to agree to increased pricing of the products. So when we will do financial analysis and we will see all the details and how the numbers move and what is the story behind those numbers, we will find out that if you are able to see stable profitability margins in today's environment where business is exposed to so many risks and so many competitive pressures that everybody is willing to sell stuff at a lower price just to gain market share. If you find that a company has got stable profitability margins, it means it is doing something really good. So that needs to be taken note of. Yes, please. Yes. The contract has the provisions of change in pricing every 3 months or every 1 month. The contract is long term. Yeah. So now let us come to again that capex. Company has also planned capex towards butyl phenol and PAP for this, which is expected to fuel and let's say project risk. Here it is. The size of the project around 700 crore is being more than its net worth, which is 675 crore. So here we got the information that what is the size of that project also. So when we would analyze the company, we will try to see how much cash it makes every year and how much time it needs to spend the 700 crore and how much money it would be able to generate from internal accruals or from its business, so that we would be able to make a rough idea whether the company is spreading its resources too thin, or tomorrow it might get into trouble, all those things. But for that we at least need this information that company is making a project and the project has got around 700 crore worth of size. So all this is the information. This is for Vinti. Different credit ratings would have different information available in their reports. Now I'll answer 2-3 questions which were asked. Number one, who pays for the report? At the end of the day, credit rating agency has got a setup to run. There is an analyst who is spending time, etc. So there is a cost attached to it. Till now, the key business model which is being followed in rating business is that the borrower pays for it. So if Vinti Organics has got this report, Vinti Organics pays for the report. Somebody else will have to pay, either the borrower or we as equity investors or the bank who is mandated to get this report as per regulatory guidelines. Somebody has to pay. At the end of the day, whoever is getting the benefit in this case, it is the Vinti Organics which is getting the money to use for its projects, etc. So finally the benefit is being who is the one seeking the business transaction. See, the seeker of business transaction is Vinti Organics approaching a bank to take the loan. So at the end of the day, the person who is initiating the transaction has to bear all the costs. So somebody has to pay. In this case, the borrower pays all the costs. So when the borrower has to pay, then there come certain instances that the borrower will do credit rating shopping. That he will approach 3 different credit rating agencies, and whoever is willing to give the highest credit rating, the borrower will go to that particular credit rating. So if there is credit rating number 1, number 2, number 3, the finance guys will approach every company. Somebody might say that we would be looking at your publicly available data, we might give you a rating of A. Somebody might say we will give you A+. Somebody might say we will give you AA-. So naturally the person has got the intention of going to the company which has got the highest credit rating. Why? Because the higher you are on that spectrum of AAA to D, the safer it is to lend to you, and the safer it is, the lower would be your interest cost. So if you have taken a loan of 100 crore and because of your rating changing from A to AA-, if you get a benefit of reduction of interest by 1% every year, so at 100 crore this amounts to 1 crore every year. And for the companies which have got debt of 1 lakh crore, it would amount to around 1000 crore every year, 1%. So because there are monetary aspects involved, the intention of the companies is to get as highly rated as possible, which brings us to another aspect, that if a company is currently credit rated by rating agency 1 the business development relationship managers of other companies might be wooing this company saying that you come to us, you give your business to us, we will give you a higher rating. So those aspects also need to be taken care of while we interpret what is the rating being assigned. So when one company moves from one credit rating agency to another, most of the times, like there is annual review.
Pinatrix. சிக்கன் வரும் ப்ரீடிங் பண்ணுவாங்க மசாலா அந்த சீக்ரெட் ரெசிபி மிக்ஸ் பண்ணுவாங்க அவங்க படிக்கிறது தான் இதுதான் மோட்டர் கடையில் போகிறாங்க அவங்க பீட் பண்ணுறது ஒவ்வொரு
of the rating.